discussing about put call parity. Firstly, we talked about put call parity in the absence of any return or any carrying cost connected with holding the underlying asset during the life of the option. Then we talked about then we relaxed this assumption and we talked about the situation where a certain amount of dividend is expected or is anticipated at a particular point in time in the period 0 to capital T, that is the maturity of the option. And we saw that the put call parity gets modified. The put call parity gets modified to the extent that the carrying cost or the cost associated with the holding of the asset, the buying and holding of the asset gets reduced by the present value of the income that arises during the life of the option contract. If you would recall, it is very analogous to, it is almost absolutely identical to the situation that we found in the case of forward pricing, in the case of arriving at a forward price for a forward contract. So, the situation is very similar. The price of the acquisition cost or the net acquisition cost of the underlying asset goes down by the amount of the present value of the dividend. And similarly, the converse also holds. For example, if the asset is such, let us say it's gold or silver or such similar asset, which entails a certain amount of storage expense, or for example coal or some similar asset which entails a storage expense in terms of rent or go down rent or insurance or whatever, then the S naught factor or the cost of acquisition will get increased by, enhanced by the present value of the carrying cost over the life of the option contract. And secondly, I emphasize that the two portfolios that I constructed, A and B, are not sacrosanct. You can migrate between the portfolios A and B as you like. There are four quantities here. If you recall, there is a call option, there is an investment or a flow of certain amount of money at the risk free rate, then there is a stock, the underlying asset, and there is a put option. You can migrate them between portfolio A and B. In fact, you can even have a situation and arrive at the same result by keeping them all in one portfolio, provided the algebra is correct, provided you have the appropriate positions, long and short positions of the asset, so that the net results or the net cash flows at T equal to capital T either become 0 or become identical between portfolios A and B. Now, we can move to the next case, again parallel to the case we had in the forward case contracts, where we have a yield, a percentage yield. In the previous case, we had a certain money amount. A dividend was given in terms of a money amount, a certain amount of dollars, a certain amount of rupees, a certain amount of quantity of money. Here we are talking about a percentage yield on the underlying asset. If you hold the underlying asset, you are getting a certain percentage yield on the value of the underlying asset. In this case, the only variation that takes place, if you look at it carefully, the only variation that takes place is here. Now, in the previous cases, we had bought 1 unit of the asset. We had taken a long position in 1 unit of the underlying asset. Now, because the underlying asset is growing at the rate of Q, continuous compounded, Q percent continuous compounded. Therefore, in order to have 1 unit of the underlying asset on the date of maturity of the options contract, you need not have 1 unit of the underlying asset at T equal to 0. You need only e to the power minus q t units of the underlying asset at T equal to 0, because that will grow due to the yield, and that would grow at a factor q, exponential factor q, and you will get 1 unit at this point in time. As you can see, this quantity e to the power minus q t is growing to 1 unit here, 1 unit here, which is being sold in the market to arrive at to get a cash inflow of ST. And this e to the power minus q t that I have to buy at T equal to 0 will cost me S naught into e to the power minus qt. S naught is the price per unit. S naught is price for 1 unit. Therefore, because you are going to buy e to the power minus qt units, so the total cash outflow on account of buying the asset at t equal to 0 is S naught e to the power minus qt, and this realizes ST on maturity of the option irrespective of this state of evolution. So, the rest of it is almost exactly same, and we arrive at the put call parity. Put call parity gets slightly modified. Instead of S naught, we now have S naught e to the power minus qt. Again, this is parallel to the situation we had in the case of forward contracts. Now, we move to bounds on, now these are bounds on European options or European calls to start with, then we talk about European puts as well. The important thing here is when I talk about bounds, these are theoretical bounds. These are bounds which are dictated by no arbitrage considerations. In other words, if these bounds are violated, then there is a possibility of arbitrage. It's not that these bounds cannot be violated at all. There may be situations in the market when these bounds would be violated, but if these bounds are violated, arbitrage pressure will come up and the prices will realign themselves in such a way that the equilibrium prices move back to within the bounds. Let us look at this. Let us start with a very simple case. Let us talk about a call option. We buy a call option, again we have a payoff of ST minus K if ST is greater than K and 0 if ST is less than K. This is becoming more and more obvious as we are discussing. We short 1 unit of the stock. We short 1 unit of the stock. If you short a stock, that means you borrow the stock and sell it in the market. If you sell it in the market today, the price that you get is, now this is a cash inflow, it is not an outflow, it is an inflow. You have sold the stock in the market, you simply borrowed it and sold it in the market, but you have to redeem it at a later date by buying it in the market and redeeming it to the owner from whom you have borrowed the stock. So, you sell it at S naught, and because you are going to buy it in the market at S capital T on the date of maturity of the option and return it to the replenish it to the original owner, the cash outflow at that point in time will be ST. It will be an outflow. This will be an outflow. This will not be an inflow now, because you have to buy it from the market and give it back to the original owner, and you invest this amount of money which comes back to this. Now, if you look at this situation, let us look at this situation. Let us work out the aggregate cash flows. ST minus K minus ST, ST cancels out, K cancels out. So, in this scenario, when ST is greater than K, the cash flow from this portfolio is 0. If ST is less than K, the net cash flow is K minus ST. But please note, ST is less than K. Because ST is less than K in this particular situation, ST is less than K and your cash flow is K minus ST. Therefore, in this situation you are having a positive cash flow. So, there is one situation at T equal to capital T, which is the majority of the option. At T equal to capital T, we have two possible situations, two possible states. There is one state at which the cash flow is 0. There is the other state at which the cash flow is positive. There is no state at which cash flow is negative. You can see there is no state at which the cash flow turns out to be negative. That means what? That means if you are investing in this portfolio, either you are going to get a 0 return, 0 cash flow on maturity, or you are going to get a positive return or a positive cash flow on maturity, either a 0 cash flow on maturity or a positive cash flow on maturity. There cannot be a negative cash flow on maturity. Now, because there is some semblance of probability, now whatsoever it may be, but there would be some probability, howsoever small, that this state occurs at T equal to capital T. There may be a large probability, there may be a small probability, howsoever small it may be, but there is. The important thing is that there is some finite probability that this state can occur, and because there is some finite probability that this state can occur, that means this combined cash flow will command a positive price, at t equal to 0. In other words, let us put it this way, this total portfolio is better than a portfolio which gives you 0 under all circumstances. Suppose there is another portfolio, let us say there is a portfolio called Q. When that portfolio gives you 0 here, it gives you 0 here. In other words, it gives you 0 if ST is less than K, it gives you 0 if ST is greater than K. That means what? That means the worth of that portfolio must be 0, because you are not going to get anything from it. But this portfolio definitely carries a finite probability of giving you something more than 0, and therefore, it must have a positive value. This cost of this portfolio must be positive. Cost of this portfolio must be positive means C minus K e to or C minus S naught, because S naught is an inflow, plus K e to the power minus R t must be greater than 0, or C must be greater than S naught minus K e to the power minus R t. C must be greater than S naught, C must be greater than, this is a mistake here, C must be greater than S naught minus K e to the power R t, and C must be less than S naught. I will come back to this in a minute, but C must be greater than S naught minus K n, because the cost of this portfolio must be greater than 0, because it is promising some positive return howsoever small, and the cost is C. C is the price that you are paying for the option. This is the amount of investment, that is again a cash outflow. So, C plus this thing minus S naught, which is the amount that you are receiving by shorting the stock, this must be greater than 0, or C must be greater than S naught minus K e to the power minus R t. So, that is the lower bound. This is the lower bound. This is the lower bound of the European call option. Now, we come to the upper bound. Now, what does the call option give you? The call option gives you the right to buy the asset at a particular price. Therefore, the price of the call option can never be greater than the price of that particular asset at that point in time. Let me repeat, the price, the call option is giving you a right to buy the asset. So, the best you can do with the call option is buy the asset. So, therefore, the value of the call can never be greater than the value of the asset. Therefore, C must necessarily be less than S naught. So, C must be greater than S naught minus K e to the power minus R t, and C must be less than S naught. These are the two bounds. This is the lower bound, S naught minus K e to the power minus R t, and S naught is the upper bound of the European call. Now, we talk about European puts. More or less a similar logic. You buy a put option, you pay a certain price for that P, and the payoff that you get in this case is K minus S t if S t is less than K, and if S t is greater than K, you get a payoff of 0. You buy this stock, if you buy this stock, you pay S naught, it is an outflow, and you receive this S t and S t on maturity of the option, and you borrow a certain amount. If you borrow a certain amount, it is an inflow here and it happens to be an outflow here. So, if you totaling all this, adding all this, S t and S t cancel out, K and K I get 0, and here I get S t minus K, but please note S t is greater than K. S t is greater than K. Therefore, S t minus K has to be greater than 0. Again, applying the same logic that we did in the previous case, we have a situation again where there is a portfolio that is giving you a payoff of 0 in one state and a positive payoff in the other state. So, it has to be better than a portfolio which gives you 0 payoff in both the states. And therefore, because it is giving you, it is better than a portfolio which is giving you 0 payoff in both the states, and at least some positive payoff is there, and there is no negative payoff, There is no negative payoff in either case. In this case it is 0, in this case it is positive. So, there is no negative payoff. There is only the possibility, there are only two possibilities, 0 payoff and positive payoff. Positive payoff may be large, maybe large in terms of probability, or maybe small, but nevertheless it is positive. Some finite probability exists for this particular state also to materialize at t equal to capital T. Therefore, the cost of setting up this portfolio must again be positive. Now, while calculating the cost, we have to be very careful, because here we are using the convention that negative means outflows and positive means inflows. So, we have to be very careful when we calculate the cost. For example, if you are buying a put, then P is a cost, and if you are buying a stock, then S naught is a cost, and this is an amount which is borrowing, which is an inflow. So, P plus S naught minus K e to the power minus is the net cost of this particular strategy, and this has to be greater than 0. Therefore, P has to be greater than K e to the power minus R t minus S naught. P has to be greater than K e to the power R t minus S naught. We have to be careful about the signs when we use when you work out the cost. The cost has to be positive. So, that is one part of the thing. So, the lower bound of a put option is given by K e to the power minus R t minus S naught. K e to the power minus R t minus S naught, because the cost of setting up of this portfolio has to be positive. This is a cost, this is a cost, this is an inflow, this is negative cost, you may say negative cost, or an inflow. Therefore, P plus S naught minus K to the power n must be greater than 0, because we are talking about a positive cost must be positive. So, this gives you this relationship. Now, we talk about the upper bound. Now, what is the meaning of a put option? A put option is an option which gives you a right to sell an asset at a particular price. Therefore, its value can never be more than that particular price. That is the first obvious thing. Because it gives you the right to sell an option at a particular price, its price can never be greater than that price. So, the put option P has to be less than K. That is one part. But when will that K be realized? That K will be realized on maturity, not today. We are talking about European puts, and European puts can be accessed only on a particular date, and on that date you get the exercise price. That is what the European puts are, give you the right of. So, as on capital T, P entitles you at best of exercise price K. So, today's value of that option, today's value of put cannot be greater than the present value of this exercise price. Therefore, we must have P is less than K e to the power minus R t. E to the power minus R t, present value of what? Of the exercise price. So, these are the two bounds of the put option. Cost, the lower bound is K e to the power minus R t minus S naught, and the upper bound is K e to the power minus R t. Just to recall, in the case of a call option, the lower bound was S naught minus K e to the power minus R t. So, this it gets reversed, and the upper bound was S naught. These are theoretical bounds, and they are determined by no arbitrage requirement. Where does arbitrage come into play? Arbitrage comes into play when we argue that this being positive must command a positive price. That is where arbitrage comes into play. A positive payoff must command a positive price. That is where arbitrage is involved in this analysis. Again, this is the same analysis, but when we have a certain amount of dividend. As you can see, the conditions simply get modified to the extent that instead of S naught, we replace S naught by S naught minus D naught, S naught minus D naught, because when you get a certain dividend, you can borrow against this anticipated dividend and set off part of the cost of acquisition of the stock of the underlying asset, and therefore your net cost of acquiring the asset goes down. Now we talk about American options. Just to recall, what are American options? American options are those options that can be exercised at any time. Now please note this, European options are to be exercised at a particular time, at maturity they can be exercised on a particular day, whereas American options can be exercised within a particular period up to maturity. So, to that extent, obviously American options are more flexible than European options. You can exercise them anytime within this period. Therefore, because this American option, in addition to whatever is contained in the European option, it also gives you the flexibility of exercise in terms of timing. Therefore, the price of the American options must at least be equal to that of the European options and could be more than that of the European options. The price of the American call, which is represented by capital C, may be equal to or greater than the price of the European option, corresponding European option, and similarly the price of the European put option, price of the American put option can be greater than or equal to the the European put option. Why? Because they give you a certain additional right, certain additional flexibility. What is that flexibility? That flexibility is the right to exercise within a particular period. So, whatever is there in the European option, you have that right as well, plus you have something more, you can exercise that right whenever you like up to that particular point in time. Now, we come to a very, very important analysis, very, very important. The argument is that if you have a non-dividend paying stock, there is an underlying asset, there is an underlying share, underlying stock which does not pay dividend during the life of the option. So, you have a non-dividend paying stock, that is called a non-dividend. You have an American option on this, American call on this particular stock, which is not going to pay any dividend. This is maturity, this is 0. The argument is, or rather the contention is that it is never optimal to early exercise the American call. In other words, you do not benefit as the holder of the American call, you do not benefit by exercising the American call early. So, what does it mean? It means that there is no benefit attached to the American call option, because it will never be optimal for you to exercise the American call earlier than maturity. But European options are exercisable on maturity. So, American calls to that extent with this argument do not entitle you to any benefit on account of non-optimality. Let us see the argument. This is very interesting. Let us assume that you hold an American call and you hold the American call at t equal to 0, you have taken an American call. Let us assume that at any point t equal to tau, you decide to exercise the option. American call, remember American call, not put. American call, you decide to exercise the option. Obviously, you will exercise the option if S tau is greater than k, because if S tau is less than k, you are not going to get any payoff. It is a call option. So, the first premise is that if you are going to exercise the option at any point in time tau, at that point in time S tau must be greater than k. That is one thing. Now, let us look at two situations. You exercise the option, what will you get? You will get this stock You will pay a certain amount of money equal to the exercise price, and you will get 1 unit of the underlying asset, that stock. Now, there can be two situations. Let us, the first situation is that you get the stock and you hold it till the maturity of the option. Let me draw the timeline. Let us say at this point tau, you decide to exercise the option, and let us say this is the maturity of the option. Now, at point tau you have exercised the option. What have you got? You have got the stock at a price S tau and you have paid a price K. You have paid K, you have got a stock whose market value was S tau. Obviously, S tau is greater than K, that is also understood. Now, there are two situations. One situation is that the asset that you have acquired by exercising the option, you decide to hold it for the remaining period, that is you hold it yourself for the remaining period up to capital T, or you sell the stock in this intervening period, that is between tau and T. You exercise the option, you have the stock and you sell it off in the market. And the first option is you do not sell it in the market, you hold it. Let us talk about the first case first. In the first case, you are holding the stock up to maturity. So, as on the maturity, what is your portfolio? Your portfolio comprises of 1 unit of the stock. Your portfolio comprises of 1 unit of the stock. Now, suppose you had not exercised the option, then your portfolio would have comprised of 1 American option that you could have exercised on that day. Now, obviously, because it is an option, it is a call option and it is exercisable on maturity as well. Therefore, you could as well, no, this is very important, you could as well have exercised the option on maturity, given the same price K and received the stock. So, you are again in the same situation. You have 1 unit of the stock, you have given the same price K, and in the previous case you had given the price K at an earlier date and you have got 1 unit of the stock. So, in both the cases where you have exercised the option at tau and you have exercised the option at T, you are end up with 1 unit of the stock, that is clear. In the first case, when you exercise the option at T equal to tau, you made the payment earlier and the same payment K. In the second case, you made the same payment K, but at a later date. So, if you adopt the first strategy, you lose the interest for the period between tau and T on an amount K, because in the second case you are making the same payment at T equal to T, capital T, which is later. In the previous case you made the payment at an earlier date. So, you lose the interest for the period T equal to tau to T equal to T on the amount K, that is one loss. Secondly, suppose the price of the stock goes down at T equal to capital T. Now, in the first case, because you have exercised the option already, you are bound to have the stock with you and the entire loss of the fall in price will be to your account, howsoever gigantic it may be, because you have the stock and you cannot escape from it. However, if you have not exercised the option, you can reconsider your decision. In other words, if you feel that the price has gone down substantially, you may still take the decision not to exercise the option. In that case, your loss is confined only to the amount of premium that you have paid on the American call and not more. However, but if you have exercised the option, then the entire loss on the stock is to your account, because you are the owner of the stock. So, these two factors imply that it is definitely beneficial, to delay the exercise of the American call up to maturity in the situation that you decide to hold the stock up to maturity. Now, we come to the second case. Now, in the second case is when you decide to sell the stock. Let us look at two situations. Situation 1, you exercise the option and you sell the stock. Exercise the option, option and sell the stock plus sell stock in tau comma t. And the second situation is sell option unexercised sell option unexercised. Now, if you compare these two situations from the perspective of the buyer, a person who has bought the stock from you. Now, if you look at this, the profit that you are going to get, let us say you sell the stock at point tau, then the profit that you get is S tau minus k. However, in this case, the price that you are going to get from the option is more likely than not going to be higher than this value. Why it is going to be higher than this value? It is going to be higher than this value because the buyer of this option, this particular option can do everything which this person can do. In other words, he can exercise the option, and once he exercises the option, he gets the stock. So, he is brought to the same position as this particular situation. The person who buys the stock can as well exercise this option and convert the option to a stock. So, it amounts to the same thing, but in addition to that, the buyer of this option also has that insurance that we talked about earlier. If there is a fall in the price, he can decide at a later date whether he would exercise the option or he would not exercise the option. Therefore, even in this situation, you would be getting a better price if you sell the option unexpired rather than exercise the option, get the stock and then sell the stock. So, that is why whatever the situation is, you end up with a superior position or by delaying the exercise of the option up to maturity of the option. Thank you.